Hello friends, today we are coming here to discuss a very important, small topic, an important concept in part 2, section A of Cma Us. So we are dealing with a small topic, an important topic, an easy topic in Cma Us part 2, section A. And in that we have got profitability analysis as one of the subunits. In that we are having this concept of earning per share. Earning per share is nothing but profit per share. Earning per share is a measure of performance. How the company is going to be, how the company is performing financially. If the investor wants to know, he will make use of this earning per share along with other ratios. Of course, we have done ratio analysis. So in earning per share, what we are trying to find out is what is the profit per share. Now, who finds out this profit per share? And why does he find out this profit per share? Who finds out? Common stockholders. The common stockholders are those people who are investing in the company and they have the maximum risk of loss. Why? Because they are always paid last. If it is dividend, they are paid last. If the company is closing down the business and capital is repaid, they are paid last, provided there is sufficient cash. So we say that these stockholders, these common stockholders, are the actual risk bearers of the company. Why do they calculate earning per share? I told you that it is for the performance measurement of the company. How the company has financially performed during the year. And as a result of that, how much of profits have been earned by the company, which are available for equity shareholders. So I have said profits available for equity shareholders. So we have to study a few points regarding this. How to calculate formula is there. How to calculate with the formula under different circumstances that we are going to study today. Okay. So we start by saying, let us start with the concept of earning per share. Let us know why we are using the EPS and who is using the EPS. As I've told you, earning per share is the most commonly used ratio by the investors to measure the performance of the company. Who calculates that? Common stockholders. EPS is calculated only for common stock and never for preferred stock. Common stockholders, why they calculate? Because they want to know how much of profit is left for them after meeting all expenses, after meeting the tax liability, and after meeting the payment of preference dividend. Right? How to calculate basic earning per share? Now, earning per share can be of two types. You can have basic earning per share and you can have diluted earning per share. First, we'll start with basic earning per share. When we are calculating basic earning per share, you can see that it is net income available for common stockholders divided by average number of common stock shares. Okay. So, how to calculate net income? Very simple. Net profit before tax minus tax will give us net profit after tax. That net profit after tax is the net income earned by the company. It is the net income earned by the company, earned by the corporation, earned by the business after meeting all expenses of the business and after meeting the tax liability. Now, after you calculate this net income available after tax, you have to see whether company has got preferred capital or preference capital on which we have to show, we have to calculate the preference dividend. because we are ultimately calculating what? The net income available for common stockholders, for equity shareholders, which is after payment of preference dividend on the preferred stock. So if there is any preference dividend payable, then we minus that, and then we arrive at the net income available for common stockholders. What is there in the denominator? Interesting thing. It is weighted average number of common stock shares, or we can call it as WANKs. Weighted average number of common stock shares, which is the average number. It is not the aggregate. It is not the total. It is the average number of outstanding shares on each day of that particular year. Okay, or of that particular period. So even if a share is issued, if shares are issued halfway through the year, we will take that into consideration for the period of 6 months. Even if the shares are issued on the last day of November month, 30th November, then also we calculate the shares and find out the proportionate amount of shares which are held by the investor for 1 month. So you are a shareholder of the company, whether you have shares on the 1st of Jan or you have purchased shares on the 1st of December or on the 31st of December. You are the shareholder of the company, and when we calculate weighted average number of shares, we will take into consideration your shares also, irrespective of the date of issue. That is why it is average. Average means weighted average, right? So let us now calculate take simple questions, take simple problems and solve and try to see how to calculate the basic earning per share. We start with the first one. Here in this example, we will have only common stock and there will be no preferred stock. So let us go through the question. On 1st of Jan 2021, Xeon Corporation has 100,000 shares of common stock outstanding, having a par value, face value of $10. Net income of the corporation for the year ended December 31st, 2021 was $22 million. There was no preferred stock. There is no preferred stock. So there is no question of preference dividend. There is no question of preference dividend. So whatever is the net income earned by the company after tax is to be taken as the net income available for common stockholders. Very simple problem. So I write the formula first. Always write the formula first. Formula is net income available for common stockholders divided by weighted average net common stock shares outstanding. What is the net income? Since there is no preference dividend, it is simply $22 million. $22 million divided by number of common stock shares. 100,000 shares are there from beginning, from 1st of Jan to the end of Jan, or to the end of the financial year, that is December 31st. There is no fresh issue during the year. There is no other transaction during the year relating to shares. So $22 million divided by 100,000 shares, you will get the answer as $220. So the earning per share is $220 per share. The profit is $220 per share. Okay, quite simple. Now let us come to second type. We have common stock outstanding for the year changes. That means there may be a fresh issue. There may be a bonus issue. There may be a dividend declared, stock dividend declared. So let us see. So we are having this transaction. June Corporation is the name of the company, had 100,000 shares of common stock as on Jan 1st, 2020. During the year, the following transactions took place. On April 1st, we had 10,000 shares issued in exchange for a machinery, an asset. The company has purchased machinery, and instead of paying in cash, the company has issued 10,000 shares of the company. July 2nd, declared and distributed 10% stock dividend. That means we are issuing additional shares in the form of stock dividend. December 1st, purchased 1200 own shares. Now, as you must have learned, when we buy back our own shares, we call it as treasury stock. So in bracket, I will write here treasury stock. Okay, it's a treasury stock. So when you buy back your own shares, it is called as treasury stock. It will reduce the number of shares that are outstanding. Right? Calculate basic EPS. If net income for the year, that means net income after tax, is 5,90,750. So $5,90,750 is the net income after tax, is the net profit after tax available for common stockholders. So net income is clear. Okay, net income is clear. First, to calculate weighted average number of common stock. Date wise. Now dates are important. On January 1st, 2020, I had how many shares with me? I had how many shares outstanding? I had 1 lakh shares outstanding. For how much period? For the entire year. So 100,000 shares multiplied by 12 by 12, that will give me 100,000 shares. Right? Second, and then on 1st of April, I issued 10,000 shares in exchange of machinery. So new 10,000 shares are coming, but they will be there with the company from 1st of April to the 31st of December. From April 1st to December 31st, 9 months. So proportionate average number of shares, 10,000 into 9 by 12, that comes to 7,500. Then we had on July 2nd, declared and distributed 10% stock dividend. Very important point. Whenever stock dividend is declared, those shares which are declared as stock dividend will be assumed to be outstanding from the date on which the original shares are outstanding. So if I'm declaring 10% dividend on the first 100,000 shares, that comes to 10,000 shares. I will assume that those 10,000 shares are outstanding right from January 1st, because the original 1 lakh shares or the original 100,000 shares were outstanding as on 1st January. So 10% on 100,000, that is 10,000 shares, are also assumed to be outstanding as on January 1st to December 31st. So dividend that we are paying, stock dividend, 10,000 on 1 lakh, 10,000 on this 100,000 shares. 10% of 100,000, 10,000 into 12 by 12, because that is outstanding for 12 by 12 months. Okay. Now I declared stock dividend on the second number of shares, that is these 10,000 shares, which are issued on 1st April, and they are outstanding for 9 months. So these 1,000 shares will also be assumed to be outstanding for 9 months. So 10% on 100,000 is 10,000, outstanding for same period of time, 12 by 12. 10% of 10,000 shares issued on 1st April is 1,000 shares. They are issued on 1st April. So these 1,000 shares are also assumed to be outstanding from 1st April to 31st December for 9 months. So that comes to 750 shares. Then on December 1st, we have purchased 1200 of our own shares. 1200 of our own shares. That means 1200 shares are less by the time we come to, are less outstanding by the time we come to the end of December 31st. So 1200 shares, but they are out, they are less, they are not outstanding anymore. But it has happened on 1st of December. Only for 1 month we were not having those shares. We were having those shares for 11 months. We were not having it for 1 month. So what I will do, I will take 1200 into 1 by 12 and I will subtract that amount. You can see here, I've written here treasury stock. I've told you it is treasury stock. When you buy back your own shares, it is 1200 shares for 1 month into 1 by 12. So it is 100 shares. It has to be subtracted from the total number of outstanding shares. Okay. So if you take the total of all those things, you will get 118,150 shares. Okay. This is your weighted average number of common stock. Now we have to find out the EPS of this. So let us see. My earning per share is to be calculated with net income. What is my net income? They have given my net income as 5,90,750 or $590,750. So I will have to divide that figure by 1,18,150. Okay. So first I write the formula. $590,750 divided by 118,150. We divide number of shares. We'll get answer as $5 each. Answer is $5 each. Okay. I hope you have understood this particular example. It was pretty simple. Okay. Now let us come to some variance in the capital composition. In both the examples, we calculated basic EPS. In both the examples, we had only common stock. We did not have preferred stock. Now we will have common stock and a preferred stock outstanding for the year. Okay. Question is, June Corporation had 30,000 shares of common stock and 10,000 shares of 6% preferred stock of $100 as on January 1st, 2020. There are no dividend payments in arrears, which means that all dividend has been paid. Even current year dividend has been paid. No dividend is in arrears. Current dividend is also paid. Okay. Calculate basic EPS if net income reported by the corporation. Always remember this. Net income is what? Net income reported by the corporation is $588,000. Now, first of all, there is preferred stock. So when my formula I take for calculation, it is basic EPS equals to net income available for common stockholders divided by banks. Now, what is the net income available for common stockholders? It is 588,000, but that is for both the stockholders, both preferred stock and common stock. Together, they are having $588,000. But out of that, first I have to pay preferred stock. First, I have to pay on the preferred stock. How much I have to pay on the preferred stock? How many shares are there? 10,000 shares are there of preferred stock. What is the par value per share? $100. So what is the amount here? Amount is $1 million. On $1 million, I'm going to calculate at the rate of 6%. At the rate of 6%. Okay, so that will come to 6,000. So net income available for common stockholders is equal to 588,000 minus preference dividend 6% of $1 million. That comes to 6,000. Sorry, 60,000. Okay, 6% comes to 60,000. 5,88,000 minus the preferred dividend of 60,000. That gives me 5,28,000 or $528,000. So that is my net income. How many shares are there outstanding of common stock? 30,000 shares. So I will now say that Vanks is 30,000. For the full year, it is there. So basic EPS $528,000 divided by 30,000 shares. That comes to $17.6. Basic EPS $17.6. Any difficulty? So here I have taken this calculation is for preference dividend minus the preference dividend. So net income available for shareholders, stockholders, both preferred and common stock together, it is 5,88,000 or $588,000. But out of that, I am interested in what? I am interested in net income available for whom? For common stockholders. So minus from that, the dividend that is to be paid to the preferred stockholders. Now, there is a small important thing that I have to mention here. The problem has given, the question has given that no dividend payments in arrears, meaning nothing is outstanding. The dividends are not outstanding, they have been paid. So I will make a small assumption here. What is the assumption? Since it is given that no dividend arrears are there, we can safely assume that preferred stock is non-cumulative. Preferred stock is non-cumulative. Okay, I'll come back to this point when I'm doing the problems later on. What is the difference between a cumulative preferred stock and a non-cumulative preferred stock? Cumulative preferred stock means that if in any particular year your dividend is not paid, it will be accumulating. That is why the word comes cumulative, accumulating. It will accumulate till the year where you are having profits. And before you pay any dividends to the common stockholders, the arrears of preferred stock has to be paid if they are cumulative preferred stock. Okay. So I hope you have understood this example. Common stock and preferred stock is outstanding for the year. What is the difference here? Oh, same problem. June Corporation had 30,000 shares of common stock and 10,000 shares of 6% non-cumulative preferred stock of $100 par value as on 1st Jan 2020. But they have said no dividend is declared in the current year. And the most important part is that they have given to you that it is cumulative. They have given to you that it is cumulative. Okay. Now, if that is the case, no dividend is declared in the current year. How to solve? It is non-cumulative, sorry. It is not cumulative, it is non-cumulative. Cumulative preferred stock, I told you. In the case of cumulative preferred stock, if dividend is not paid in any year, it is going to accumulate, it is going to add, and as and when you have profits, before declaring dividends on common stockholders, you have to pay the dividend on the cumulative preferred stock. This is non-cumulative preferred stock. That means dividend, if it is not paid in any year, forget about it. Dividend is not paid in any year, forget about it. You are not going to get the dividend in the next year. As simple as that. Now, if the stock is non-cumulative, if the preferred stock is non-cumulative, what you have to remember is, if dividend is not declared, then you cannot subtract dividend from the net income, because you are not entitled to. Cumulative preferred stock, you have to pay dividend, whether it is declared or not declared. If not in the current year, in the next year, dividend is payable, right? So if it is a non-cumulative preferred stock, there is no such right for the stockholders. So if dividend is not paid, bad luck, you don't get anything, right? So non-cumulative preferred stock, I will subtract the dividend only if dividend has been paid and has been declared in the current year. Only if dividend is declared in the current year. But they have very clearly mentioned no dividend is declared in the current year. So preferred stock, we don't have any dividend declared. Bad luck for preferred stockholders. So that means no dividend means from the net income, nothing is to be paid to the preferred stockholders. Everything belongs to the equity stockholders. Formula: net income available for common stockholders divided by banks. So net income available for common stockholders is 5,88,000. Basic EPS is that 5,88,000 is $588,000 divided by 30,000 shares. I'll get the answer as $19.6. $19.6. Now, $19.6 if I'm getting, what is the important point here? The important point is that what is different from this and the earlier example? Earlier example, nothing was given. It was cumulative preferred stock, non-cumulative preferred stock. I'm not concerned, but they had given dividend has been declared. Dividend has been declared. So I assume that it is non-cumulative. Okay. Now, they have given in the example, it is non-cumulative. On non-cumulative, I will show the dividend only if it is declared. But they have said no dividend is declared, so it is not being deducted. So since it is given that preferred stock is non-cumulative, preferred dividend is deducted only when it is declared for the year. Only when it is declared for the year. Have they declared? Answer is no. So no preferred dividend for the current problem. Okay. Anything that you have not followed? Point is clear. Exam tips now. From the exam point of view, certain points, certain things that you have to keep in mind. That is summary of what we have done up till now. First of all, if preferred stock is cumulative, then the annual dividend is subtracted each year irrespective of whether dividend is declared or paid or not. Irrespective of. Why? Because they are cumulative, they are entitled to the dividend. You are not paying in the current year, but it will be paid someday out of the profits. So if the preferred stock is cumulative, then whether the dividend is paid or not paid, you have to deduct the dividend, subtract the dividend. Second, if preferred stock is non-cumulative, then annual dividend is deducted only when it is declared for the year, during the year. If it is non-cumulative, dividend has to be declared so that I can deduct it from the calculation. A third situation, problem does not specify, okay, whether a preferred dividend was declared or not. Problem is silent. Problem is silent, whether declared or not. Here I have given specifically the statement that it is not declared or it is declared. But if nothing is given, then what is the assumption? Then the assumption is preferred dividends are declared. Okay, assume that it was declared. It's important. Assume that it was declared. Why? Because preference dividends are always declared and paid, and they are reliable. unless the company is in deep financial trouble. Okay, so the problem is silent regarding payment of dividend, whether dividend is paid or not paid. I will assume that it was paid, it was declared, and therefore I will deduct it from the calculation. Fine. Logic I've explained to you. The logic is that it has been declared normally, preferred dividends are normally declared. Therefore, it has to be deducted. Last one. If a question gives the amount of income available to common stockholders, this is a tricky part. This is a very important part. If a question gives the amount of income available to common stockholders, that is already for the final shareholders, do not subtract any preferred dividend from it. Why? Because it has already been subtracted and they have arrived at the final figure. So after they have subtracted and arrived at the final figure, you don't have to further subtract. Then there will be double calculation. Income available to common stockholders is net income minus the preferred dividends already. So you don't have to subtract further. It is already subtracted. So always read the question, whether it is income available for common stockholders or income earned by the corporation. Income earned by the corporation means it is net profit after tax. Then minus the dividend, preference dividend, to arrive at net income available for common stockholders. Okay. If you are already given, that means now, if it is net profit after tax, then I say minus preference dividend, and I will have net income available for equity shareholders or common stock. But if this is already given to you, don't have to further subtract preference dividend because you have already deducted the preference dividend to arrive at that figure. You followed? So these are some examples for the first part, that is basic EPS. Now let us come to diluted EPS, diluted earning per share, or DEPS. In case DEPS is to be calculated, in case diluted earning per share is to be calculated, how it is going to affect my problem? First of all, what is the meaning of diluted earning per share? There is a possibility that there may be some stock warrants, there may be some options, there may be some convertible preferred stock, or there may be some convertible debentures or debt or convertible bonds which are issued by the company, where the company says after a particular period of time you may convert these bonds, you may convert these preferred stocks into common stock. They are convertible at a future date. So in future, my weighted average number of common stock is going to increase. So my denominator of that formula for basic EPS we are calculating, that denominator increases. Now you must have learned in ratio that in any ratio, when denominator increases, the ratio decreases. But at the same time, numerator also increases because I'm converting a bond into a common stock. In that case, the interest that was payable on the bond earlier is no longer payable now. So that will increase my profits, that will increase my net income available for common stockholders. Right? So my net income will also increase by the amount of interest payable on those convertible bonds, but net of tax. Net of tax. However, if you are having convertible preferred stock, then how is the net income affected? If I'm having convertible preferred stock and if the stockholders exercise the option of converting the preferred stock into common stock, then preference dividend is no longer payable. because the preference shares will not be there. They are going to be converted into common stock. So preferred stock is not there. So in that case, preferred dividend will not be there in future. So in that case, my net income available for common stockholders will increase because there is no preference dividend to be paid in future. So add back the preference dividend, but no deduction of tax. No deduction of tax. Interest, I will have to deduct tax. Preference dividend, I am not supposed to deduct tax. Okay. So in case DPS, that is diluted EPS, is to be calculated, then numerator is increased by the amounts which are no longer payable on the convertible preferred stock or convertible debt. If it is interest on convertible debt, it should be taken net of tax. If it is dividend on convertible preferred stock, then tax should not be adjusted. I'm emphasizing here, tax should not be adjusted. Diluted earning per share will be calculated only when company has complex capital structure. MCQs, important, complex capital structure. That is, it has potential issuable shares, potential convertible in future, potential issuable shares which have not yet been issued on convertible preferred stock or warrants or convertible debt. Okay. Any problems? Any difficulty? Now, I think it is very super clean and which is super easy to understand once all these points are put in a systematic format. That is why the purpose of the lecture is to simplify the things, to help you to understand the concept and calculate the values. What you can do is, in case you don't understand something, you can rewind back and see what has been done. You can copy down the examples. So these are the benefits that you are getting from my lecture, students. Take the maximum benefit of my lectures and ensure that your concepts are clear. If not, you can always contact me. Number is there. Okay. And it will be answered by me only, whatever difficulties you are having. Right. So now let us do one question on diluted earning per share. Okay, now the question is, why do we call it as diluted earning per share? Because the earning per share, the basic earning per share will be reduced. It gets diluted, it gets reduced. Okay. Sugar, if it is there, you are eating plain sugar, very sweet. You dissolve it in water, it gets diluted. The sweetness spreads. The sweetness reduces. It gets diluted. Right? So the water will not be as sweet as the water that you are drinking may not be as sweet as the sugar that you would have put into your mouth directly. That is dilution. So diluted earning per share is normally less than the basic earning per share. If, very important point, if after calculating diluted earning per share, you find that, oh, this diluted earning per share is now higher than the basic earning per share, then we can't call it as diluted earning per share. It is called as anti-diluted. It is called anti-diluted. So if your basic earning per share is $10 and you're getting diluted earning per share is $12, you can't get that because $12 is more than $10. So where is the dilution? Dilution means that it should be less than $10. So then it is anti-diluted. Okay, fine. Let us take an example on this. June Corporation had 30,000 shares of common stock and 1,000 shares of 6% convertible preferred stock. 6% convertible preferred stock of $100 as on 1st Jan 2020. Each share of the preferred stock is convertible. How many shares are there? 1,000 shares. Each share is convertible into 10 shares of common stock. 10 shares of common stock. That means For 1,000 shares of convertible preferred stock, you will get 1,000 into 10. 10,000 shares of common stock. Additional may come in the future. Okay. Calculate DEPS if net income available for common stockholders is 588,000. Common stockholders. Okay. Now, formula same, but net income I will have to calculate. Net income available for common stockholders was $588,000. But in future, when those preferred stocks are going to be converted into common stock, preferred dividend is no longer payable. How much is preferred dividend? 1,000 common stock, 1,000 preferred stock shares are there into $100 each. Okay. So you have $100,000 of common stock. 6% of that will come to $6,000. 6% will come to $6,000. So in future, your $588,000 will increase by $6,000 because no preference dividend is to be paid in future. So I say 588,000 plus 6,000. Remember, I told you preference dividend, no tax reduction. No tax reduction, full amount. So 588 plus 6, I'll get us 5,94,000. So my net income available for common stockholders is $594,000. How much is my Vanks now? Vanks is original 30,000 common stock, and these 1,000 shares of preferred stock, each share is going to get 10 share of common stock. So I will have 10,000 more of common stock. So it will be 30,000 existing plus 10,000, which are converted from preferred stock to common stock. So my Vanks will be 40,000. So diluted earning per share is 5,94,000 divided by 40,000. So that comes to $14.85. Now, is it actually diluted? What is my basic earning per share? Let us check. Only if my diluted share is less than the basic earning per share, then it is diluted. Otherwise, it is anti-diluted. Basic earning per share. Net income available for equity shareholders, $588,000. Upon original equity shares, 30,000. Okay. So I am calculating 588,000 divided by 30,000. It comes to 19.6. Basic is 19.6. So it is dilutive because the figure is less. You can compare this. So diluted earning per share should normally be less than the basic earning per share. However, if it is more, then it is anti-dilutive. Okay. Let us take the next example. What is the change? June Corporation had 30,000 shares of common stock, 6% convertible debt of $100 of $100,000 as on Jan 1st. The 6% debt is convertible into 10,000 shares of common stock of $10 per value. Calculate DEPS if net income available for common stockholders is $588,000. So what we are now having is, instead of preferred stock, I'm having convertible debt. Interest. 5,88,000 is the amount of net income available for common stockholders. Rate of tax given 30%. Formula: diluted earning per share is net income available for common stockholders. Now, net income available for common stockholders is $588,000 plus interest 6% of $100,000. How much is the interest? It is 6% of $100,000. So that comes to 6,000 minus 30%. 30% of this is 1,800 minus 1,800 from this. So how much will it be? 4,200. Okay. So net income available for common stockholders, I will say $588,000 plus 6,000 interest minus the tax. When it is interest, you have to take net of tax minus the tax of 30% on 6,000, 1,800. So it will come to 4,200. 588 plus 4, 592, 200. Okay. What will be your bank's existing 30,000 shares? Plus you are going to convert them into additional 10,000 shares. So 30 plus 10, 40,000. So DEPS, diluted earning per share, is $592,200 divided by 40,000 common stock shares. That comes to $14.81. Again, if you want to check, you can check the basic EPS. Basic EPS will be 588 divided by 30,000. 588 divided by 30,000. So you get the same answer. 19.60. Right? So you can see that concept was very simple, but some small minor points you had to make note of. So these are the things that we have to do. Calculations, basic earning per share, diluted earning per share calculations will come for MCQs in the examination. It has been asked in the past, it can be asked in the future. So keep yourself thorough with this calculation, right? So today we have taken up earning per share, which is a part of your CMA US part 2, section A, right? We'll come back with more topics. So your exams go smoothly and you are going to clear the exam in the very first attempt. Thank you. Have a nice day. Bye.